Thank you very much, everyone. Thanks for joining us back at the Edelman Investor Summit. We've had a fascinating morning with the two panels we've had. There's been a lot of very interesting views expressed. So my name's Iain. I'm the Managing Director of Edelman Smithfield, and we're here today on the next of our panels. So we've heard the macro environment and the uncertainties there. There was some interesting views expressed there early in the morning. We've heard a lot about the pressures on companies to embrace sustainability and the sort of hard realities of what that means, which I think we might come back to later on. But we're here to think about what all this means for leadership, what this means for governance. What does it mean to be a CEO or on a board of directors in this environment with all these different pressures that you're now facing? It's quite a different world. And as we think about the governance frameworks that we put around that, there's quite a lot of interesting things to think about. And according to our Edelman Investor Trust Report, the survey that Andy referred to earlier of institutional investors, 90% of investors, quite logically, say they need to trust the CEO of a company in order to invest in the shares. Now, what does it take to trust the CEO? What does good leadership look like in this environment with COVID? And all that brings with the sustainability agenda and the ESG agenda, there's a lot of interesting things to think about. So I'm very grateful to be joined by a prestigious panel who know a lot more about everything than I do. Starting with Adrian Gray, Global Chief Investment Officer of Insight Investment, one of the world's largest fixed income investors. With Eoin, Head of Investment at Federated Hermes, an institution with a long track record in the governance sphere and a long history in campaigning and issues. And with Amra, Balic, Head of EMEA Investment Stewardship at BlackRock, who over the last 10 years in particular has really elevated the agenda on a number of key topics and become a major voice in all the kind of topics that we're here to talk about. And so essentially, we're kind of asking the question: what does a good leader look like today, and how do we put governance around that? And Adrian, as a fixed income firm, downside mitigation is obviously a big factor of what you're looking at. You need to make sure you're getting your investors' principal back, aside from anything else. And with all the uncertainty out there and the varying views and the macro perspective that we heard earlier, what are the main leadership qualities that you are looking for in companies right now, and what are the governance factors around that?
Yeah, and perhaps, well, first of all, thank you for inviting me here. Perhaps for a fixed income perspective, look, traditionally at Insight, we've always tried to calibrate risk and return to the benefit of our clients and navigate through whatever investment environment we're in. But I think there's genuinely a third dimension now, which is ESG. And I think it's been somewhat underappreciated, the role that potentially fixed income is going to have in this space. But I go as far to say as it's played a little bit second fiddle to the equity side of the securities trading markets. And I can make a few points. So number one, fixed income markets are much, much bigger by a multiple than equity markets. Number two, as we've heard previously, the way the world is, it's extremely indebted, which means that size of market is only going to be growing. I was reading some research from Barclays last week that estimated there'll be $1.2 trillion of ESG bonds issued next year. That's up about 40 to 50% from 2021. And crucially, I think also, debt markets span both public and private markets. So I think increasingly it's beholden upon firms like ourselves to pick through all that myriad of issuance, and that's from HM governments and other governments around the world down to small private companies, and effectively play our role in influencing their behaviour. And you can imagine, having been involved in conversations with the DMO and the UK's Green Gilt programme, down to individual companies where perhaps they want to transition away from something they have been doing in the past to something they're doing in the future, and they would like some finance from perhaps ourselves and one or two others. You're in a position to effectively write the rule book. And I think one of the dynamics which will come to the fore, I think, in the next period is the role that fixed income investors can play in this whole ESG secular theme. And perhaps just to finish off, going back to the more corporate perspective, At Insight, we have this mantra, do the right thing, which cuts across how we interact with each other, how we interact with our suppliers, our clients, et cetera, and from that rather anodyne statement, you can actually, an awful lot of things trip out, even into meeting various things like our diversity criteria, matching the society we're operating in, and so on and so forth. So perhaps if I can just stop there and perhaps
So
come back
good
to that
leaders
later.
are the ones that listen to the people lending them money and do what they're told.
Yes.
Amra, I'll possibly turn to you now. When we think of leadership, we tend to think of CEOs, but obviously a lot of your engagement is with boards and directors more generally. How are boards having to change in response to the pandemic and the environment that we're in, and how's that impacting your engagement?
Thank you, Iain, and first of all, thank you for inviting me today. It has been indeed a very interesting morning. I think you are 100% right, and if I think about the work that my team does, vast majority of our conversation includes at least one board member, often more than one. And those are conversations that cover a range of topics, typical corporate governance issues such as board composition, independence, diversity, which are really important for us as a long-term investor. Over the last 5+ years, those conversations very much capture issues in relation to environment, climate being one, but also, for example, biodiversity. And then S, which I would say for those of us who have practiced this in sustainability space for longer, we will all agree that S has come to the forefront in pandemic or in this crisis. Let's call it crisis for the purpose of this conversation. What does good leadership at the board level looks like? So if I think about first or second quarter 2020, when early days of COVID, it was very obvious that the boards and the management actually converged even more so than they would normally. It was very clear that people are all in uncharted territories, so it's all hands on deck. And I think that was really fascinating, talking to board members who suddenly tell you that they feel that they are part of full-time employees of a company. And the focus on people, focus on their stakeholders came out at the forefront. You had businesses which were de facto supporting their struggling suppliers, clearly thinking about their own workforce. Can we work at home? Can't we work at home? Furloughing staff, making in some cases really, really tough decisions. And I think what has, in my mind, made the biggest difference between companies overall who have done or who have weathered this crisis better are those where the boards and the management have actually come together and really looked at that broader picture, looked at their shareholders, creditors, but equally employees and the broader stakeholders. And then last point, which maybe is coming through the conversation, even an earlier panel, is I think it's becoming very obvious that the culture, purpose, as a part of, and this overall strategy, which is kind of built on that culture and purpose, are becoming much more tangible for investors to observe, and we can observe it more than we ever have had a chance to do so in the past.
It is interesting. There is a theme coming through today that you've touched on it there about the broader picture, and we heard in some of the earlier panels about how we're moving into a more stock-specific environment, that macro trends and themes are maybe less of a driver. Or at least, the stock-specific element is there. There is more room for leadership. And we were kind of in this environment. We were chatting the other day about the difficulties. Like today, there's supposed to be an in-person event, and then we've had to turn it to a hybrid event. And as a reminder, if you're watching remotely, you can ask questions via the facility available. But in this environment, where you are kind of working hybridly, there's a lot of different tensions in being a leader in a remote world. How do you view that?
There are, Iain, and you're absolutely right. And congratulations for actually managing to navigate the last few days and put this on. So that's a fair feat on your part. I'll start by building on some of Amra's comments and offer a framework for how I think boards might, or how you might investigate how boards are working, and then offer some personal experience too. So I think it's important that if you want to understand how a board works, you need to think of it in two different ways. There's some stuff which will be very easy to assess and you can capture quantitatively, and that might be around composition, skill set, how often they meet, and experience, number of years, etc. There's other stuff, which are the softer bits, which would be around how do they interact with one another, what are the dynamics of the board, how do they function practically, what are the relationships, what are the relationships with the executive. Those are really hard to capture and understand how effective a board might be. So actually, a successful engagement from our perspective involves having conversations with the board. Now, that's hard because, as you know, a lot of the time you get stuck with the IR person, and that's as far as you get. But you need to push and go beyond that, clearly. Now, to maybe add in some of my own personal perspective, my job as a CIO has changed enormously, leading investment flow over the last couple of years. Clearly, we're dealing with a hybrid work situation. We've been through a complete lockdown, and who knows what it'll look like in the future, some sort of flexible or agile working environment. And there's a huge amount of listening that goes on. There's a huge amount of additional support that's required. There's a huge difference in what people now need from me as a leader. That's very clear. Recent graduates, less experienced individuals, they still want regular interaction and exposure to me because they think it matters. It doesn't, by the way. And less so the more experienced, who are very comfortable with, they know what they're doing. They don't need me interfering with them all the time. They're very happy to go and work away from that. So it's about finding that balance, making it effective, having a culture which embraces all of that, and that's hard because it's not traditionally where financial services or the investment industry necessarily has been.
Yeah, actually, just to get sidetracked in this for a little bit, Adrian, you've got big global teams, and I think the investment industry has taken quite different approaches to how they're kind of coming back or not. How have you found this kind of managing remotely element?
Well, I think the communication and listening point is well made, and it's very easy to be the sort of radio that transmits but doesn't receive. So you have to transmit clear messages, but you absolutely have to have the channel back so that you're receiving the feedback. And in any group situation, it's a natural human thing. Some people will be quite vocal and be forthcoming. Other people may sit in the corner and never say a dicky bird. And you can really, in a remote situation, that can be an exacerbated situation where people genuinely get left behind. So being aware of those sort of situations and explicitly having a management structure which is set out to try and mitigate those.
But it's quite interesting just thinking more generally about this culture point that you referred to, Amra. As we look at companies and as we analyse companies, especially people businesses, hybrid working's real, it would seem, so this is going to become a new factor that we're all going to have to think about, and it's going to be hard to know how to quantify that. I don't really have a question there, but
no, I think, look, I think we're in an industry which has not got a great reputation historically for having sort of large egos. I'm not sure how that squares with an environment where you have to have effectively, the metaphorical open doors and the ability for people to feel that they can come and ask you, even if they're relatively junior, without thinking, oh, I'm not going to get my head bitten off, or etc. Sorry.
No. We heard a bit about activism in the last panel. Our investor trust survey said that 88% of investors globally plan to be more activist in the next 12 months. More activist in this context means it was defined as more likely to submit proposals to an AGM, more likely to vote against executive pay deals, more likely to go public with criticisms of companies, and more likely to push an ESG disclosure. And obviously we had a bit of discussion, I thought it was quite an interesting point in the last panel around how, generic votes against the REM report or something are now getting more specific to, we're not going to vote for that director on this basis. It's clearly, there's a lot changing. Amra, I'll go to you first of all. I mean, there was a point where investors were of the view that funds that are largely passive had less of a say in these sort of debates, but that's obviously changed quite a lot. But how are you? What's your view as you look ahead in terms of how you're planning to behave or change your behaviour relative to previous years?
So let me start first by maybe using a different term, because I have for years been very cognizant about not using word passive. Maybe because of what I do, I feel that there is nothing passive about what my team does. Look, I think index investing or index tracking is a very useful, and I would go as far as to say powerful way to, over long term, influence companies on the issues that we think are critically important for success of companies that our clients are invested in. And why? Because we continue to be at the table. Yep. What does that mean? Index tracking means, if you take FTSE 100 as an example, there are names that we have been invested and will be invested for decades. There is no opportunity to walk away. Now, that puts us in a position that we can talk to companies year after year and really highlight issues that we think need to be addressed in order for companies to be successful over that long term. I would also maybe add that when it comes to term activities, activism, it seems that there is a bit of a confusion. I often get asked question, is BlackRock going to be more activist? No, we are not activist investors, and the colleague in the audience has given a pretty a good definition of what activist investors are or are not. We are, however, really long-term stewards of our clients' assets, and as such, what we are going to be doing or continue to do is to engage and vote for equities, certainly, on topics that we believe that are important. And those, as a reminder, and the list actually is getting longer, for investors to solve, and private sector full stop. But our 5 priorities are governance, so something that we talk about today, leadership as a part of it, executive pay. Again, in the UK, you can't go far in any conversation around governance without touching on pay. The third one is climate, clearly a natural capital, strategy and long-term value creation. And last but not least, the one that I really think is going to be lasting legacy of COVID is a company focus on people and bringing that S element of ESG more to the forefront.
Yeah. Eoin, turn to you next. Obviously, as we alluded to, Federated Hermes of old has a long track record of fomenting boardroom change where necessary. Do you think that investors are becoming more activist?
Yes, I think they probably are. But like Amra, I think it's important to make a bit of a distinction here. So activism I sort of see as being a particular strand, tends to be single issue, can be very public, can be quite short term, tends to want a seat on the board. Long-term engagement and stewardship we would see as being something that's quite different to that. And indeed, we would see it as being, in essence, the flip side of if we allocate capital, our investors' capital, to something, it then is our responsibility to look after that capital by being a good steward of that.
Yeah.
And actually, I think we'd make the case that that applies equally to whether it's in equities, whether it's in fixed income, whether it's in real assets, property, infrastructure, whatever. There is an obligation and a responsibility that goes with the activity of investing, and it's called stewardship. So that's I think, a really important thing. Now, for many years, the mantra was you engage the equity and you divested the debt. But again, I think from our perspective, 95% of the time, equity and debt holders' interests probably coincide. I'll be interested to get Adrian's perspective on this. Yeah. And it's really only in extremis that their interests might diverge, and you might have a more nuanced conversation. So for that reason, we've been historically, as you quite rightly point out, Iain, very active in engaging with companies, and certainly not afraid to vote against companies when necessary. We're very proud of our record. Oftentimes, though, we're doing it out of the public light. Oftentimes, we won't necessarily vote specifically on the issue. We will vote against an issue that we are worried about, but then might show our displeasure with another vote. That might be on executive remuneration. That tends to get their attention. It's a nice one.
Yeah.
And equally,
so that's still a favoured tool for attention
absolutely.
grabbing.
And reappointment back to a board, another way to make displeasure known. And I think these are very valuable tools that investors around the world should be using.
Just pause for a second. AGMs. When I was a cub reporter at the Scotsman, covering AGMs was fun. Because you'd go and you'd see a huge crowd of people who are retail shareholders, actively engaged. The last few AGMs I've been at, there's been, someone from ISS, maybe, if there's an issue. There's been one or two people rattling around. There's about 6 people and a plate of crusty shortbread, and that's your lot. Are AGMs still a good forum for governance, or is it more the lead up to an AGM and the framework of the AGM? Is the meeting itself losing its power?
I think it somewhat depends on geography. So in some jurisdictions, the AGM still does have its power, and you'll find that investors get a slot to speak, and there's some very powerful oratory that goes on in that situation. But for the most part, and in most geographies, I think you're right. Much of the hard work is done in advance of the AGM, in the run-up to the AGM. And it's not simply about being an activist investor once a year at the time of the AGM. You're an active investor throughout the year.
Yeah. Now, it would be remiss of me not to turn to you, Mr. Gray, and engage in this topic of engage the equity, divest the debt. Based on your comments earlier, you're engaging quite actively on the debt side. But in terms of what is your view on how active the debt market can be generally?
Well, it's clear there's quite a different role here. If you're a shareholder and an owner, and you have a vote, that's a very different profile to if you're owner of the debt.
Yeah.
So they are distinct roles. And I guess my point earlier is that increasingly the role of debt holders is that you do have a lot more sway over management's behaviour.
Yeah.
So if
why do you feel that? Because you can actively screw up their investment by not giving them money, or why do you feel you've got more power?
Well, in extremis, if they can't be financed, game over.
Yeah.
And most companies now have a significant amount of debt outstanding, and if they can't roll it over, then literally it is game over.
Yeah.
But what you're really talking about is the price.
Yeah.
Tobacco companies used to be able to finance themselves at a certain level, and now it's at a different level. That changes their economics. Their cost of capital has changed. Other industries don't want to go down that route. Hence, we'll do things like, if you're a bank, typically you're issuing maybe some sustainability bonds. And the question to people like ourselves, who may be one of the largest buyers of them, is what metrics do you expect to see in order to buy this? And then we have a conversation around, well, these are the metrics we'd quite like to see, let's agree those. But then you actually have to deliver on that. If it's a green bond, well, it's going to be financing this project. Can we just define that project? What are the metrics around it? So that it doesn't all of a sudden get lost in the ether, and you don't actually know really what you're. So I think there's going to be a whole industry going forward of how, driven by regulation partly, of how a lot of that stuff gets tightened up.
Yeah.
Because in the initial phase, there's a rather controversial phrase I know, but of greenwashing, there was an awful lot of green paint being sloshed around.
Yeah.
And a lot of issuance was coming out where it was all a bit fuzzy as to exactly how this mapped onto some criteria which were going to be met. Simply because companies didn't have that information to provide you.
Yeah. That's an interesting point, actually. In our investor survey, one of the things that came through is that there's more and more investors planning to actively seek out greenwashing and punish it. And so
I think the regulators are also have a part to play there.
Well, indeed. So I think it's all kind of coalescing.
Yeah.
That has to be a good thing, I think.
No, absolutely. I'm not suggesting it's not, to be clear, but it does just feel that any company tempted to try and gloss things over is making a mistake.
And the regulatory environment, I think it's for all the actors concerned, so asset owners. So, for example, if you're a UK pension fund, you're now facing off to a changing regulatory environment where you are required to disclose your carbon footprint.
Yeah.
There's a real, almost like a chain reaction, if you want. Policy and regulation is driving actually requirements for asset owners to showcase how they are protecting interests of their own underlying members, which then moves it to asset managers and how asset owners are holding their own managers to account for what they do on their behalf. But I would actually completely agree on the point around that, there is almost like a perfect storm here, which we heard the earlier comment around investors asking for disclosure. Why is disclosure so important? Because that is the key tool for us to really differentiate between companies who do this well versus those who have a long way to go.
Yeah. Now, Amra, to stick with you for a second, you mentioned the P word earlier, pay.
Pay.
And obviously incentives, executive pay, this has been one of your big areas for engagement for BlackRock. What have you observed on that topic over the past 12 months during COVID and so on? So
indeed, it is, as I noted earlier, one of our 5 priorities, and I would go as far as probably call it evergreen. Look, incentives drive behavior, and I think from our experience, I would go as far as to say that pay is often when pay goes wrong, or when we have issues with pay, it's probably because something else has also gone wrong. What we feel has driven maybe greater focus for board members on pay is this element of holding directors to account. So I can tell you the moment in time when back in 2017-18, we updated our voting guidelines and included a statement that when we vote against pay, we will be voting against directors. I think that was probably for us that we started to observe a greater focus on investor feedback. So fast forward to last 12 months or since COVID, I think we are really seeing quite a mixed bag. In continental Europe, more so than in the UK, we do feel that companies have tried to maybe shelter executives from the broader experience with their employees or broader stakeholders. How they do that? Tweaking KPIs, metrics, performance metrics. Companies' performance is suffering, but there are ways by tweaking metrics to still maybe keep executives at the same pay level.
What, like switch the metric to TSR, then do a big buyback? That kind of thing.
Well, yes, different ways, but or softening, basically reducing the expectations in certain areas. We have also noted that in some cases, companies are not maybe recognizing reputational risk with furloughing staff, taking government support, while at the same time maybe trying through some of the ways that I just explained, keeping their executives sheltered. But in the UK, I would overall, and this is overall rather than talking about specific examples because there are some, companies have been very acutely aware of the broader context.
And just to touch geographically, sorry, I'll come to a second.
Yeah.
But you mentioned different experiences in different countries. Are there any countries in particular where you struggle to get access to the right people, where you struggle to have the conversation at the right level?
Well, depending what we want to talk about, but if we are keeping it to conversation about pay, we typically want to talk to a remuneration committee chairman or members of the remuneration committee, because actually these guys or ladies are the people that we are typically voting against if or when we have issues. I would actually say that Europe overall, in comparison to other regions, is certainly part of the world where there is a lot of visibility and focus on pay, and companies know it. Let me just tell you that by Shareholder Rights Directive, now every single member state has to have some kind of say on pay. Many didn't have it before, but now they have to, even if it's advisory, there needs to be an investor say on pay. What again is really focusing mind of the boards and remuneration committees around the importance of some of these topics to investors.
Eoin, you wanted to come in? So.
I was just going to pull a couple of strands together I thought might be interesting. So on the leverage inherent in remuneration is amazing. And then to pick up on Adrian's comments around the growing green bond market and how that's, although it's impressive growth, it's still a fraction of the total bond market. Bringing those together, alongside the previous panel was talking about net zero and whether boards really gave much of a fig about something that was 2050 and seemed very distant. And we're quite right to be concerned about that, because so few of those commitments are either based in science, or certainly not science-based investment compatible, and so few of them have interim targets. how can you bring all of that together? Well, sustainability-linked bonds offer a way. So that's outcome-based bond investment. Companies have to come to refinance, as Adrian said, they're coming back to the bond markets all the time. And you could link executive pay to exactly the same outcomes. That is entirely feasible and a great way of making sure that directors and particular CEOs have their eye on the ball.
And so as a general rule, are you advocating that companies do impose some kind of link between sustainability targets of some kind and CEO remuneration?
I absolutely would, yeah.
And is that a general policy, or is it something you're looking at, or case by case?
So I think it has to be case by case. I think you need to be very clear about what the key material issues are, because they vary by industry, sector, even by company. So it can't be a complete blanket, but it's a great framework to have in your pocket.
And a question for you, Adrian, and you, Eoin, like, given you're investing across public and private companies, are public companies being held to higher standards than private companies? Is there a hurdle on being is it like a handicap almost to be a public company? Do you have to live by higher standards?
Well, public companies almost by definition tend to be larger, and hence they're better resourced to be able to deal with it. To actually deal with it. I think that's probably the main point. Private companies, the ones that certainly we would interact with, tend to be smaller, tend to have less resource. Trying to navigate all the regulatory requirements is much more of a challenge for them. But equally, the implication is that they can be much more malleable.
Yeah.
And particularly if there's a group of, say, a syndicate of, say, 2 or 3 people who are going to finance this company, you can, or you are in a position to, if not dictate, then certainly set out some requirements. And often I think the most interesting situations are where a company's generally done quite well, but doing something that's probably not seen in a particularly good light going forward. Well, how do they transition from A to B? And that arguably is where you can have the biggest impact.
Yeah.
Keep giving money to people who are doing well and give them the pat on the head. That's all well and good, but how do you genuinely help the large swathe of companies actually shift in a way which is, acceptable and economic from old world to new world?
Yeah. Eoin, do you have a view, public v private? Do the public get a harder time?
I think they probably do, and my evidence for that is if you look at the development of, say, the UK public equity markets in the US, it is a fact that there have been less and less companies moving from the private to the public world. They tend to do it when they're much older. So you've got a declining capitalization in public equity markets in both of those huge markets. So that suggests to me that actually CEOs of private companies are making an active decision not to move forward. In a sense, I don't mind, because as an active investor, I feel very strongly that it's my job on behalf of our clients to do the legwork, to do the donkey work. And I know it's similar to me to the ESG data issue. Everybody will claim about how dirty it is and there should be more disclosure. And all of that's great, but I don't mind, because if I am doing my job properly, it's easier for me to generate the right outcomes for my clients.
Okay.
Maybe just very quick observation. Talking to companies, the feeling overall is that the cost of being public, the requirements that comes from being in a public domain is just gone up and up and up year after year, decade after decade. And I think overall companies, I believe directors and management teams who get up in the morning want to do a good job. I think the struggle is that the list of items that they are being asked to deal with on day-to-day basis is definitely getting longer and longer. So to be able to differentiate, even for the boards, I get questions in terms of, Amra, climate is not a big deal for us. Do we still need to talk about it? Well, I mean, I would say no, if it's not material for your industry or for your business. But actually, it's to put it aside, I think my real point is, if we as an investor are asking for information, we really do ask it from the perspective of what is materially important for our ability to make those investments and continue to be invested. Nigel is here, he can speak about it from active side. So, but at the same time, we need to recognize that the cost of being public for companies has gone up, particularly as a result of, I would say, ESG disclosures, who companies would argue often very few read.
Yeah. Now, I did promise that I'd let other people ask questions. I'd happily sit and ask questions all day, but I can't be greedy. So I will open up the floor. Anyone got questions for our panel? Mr. Anthony Simpson at the front.
Thank you. Is this on?
Yep.
Really nice to hear some of the initiatives that you all are spearheading at your respective firms. I've read quite a number of, we're talking now about ESG and measurement of ESG policies, procedures, board experience, accountability, behavior, not necessarily the financial services industry, but across the corporate world. There have been a number of studies, a big one by PwC, one at Harvard Business School, Robert Eckley's, a couple of major search firms. The results of all these studies, sadly, are that the board level of expertise and activity are woefully inadequate. My question is that broadly consistent, all those conclusions with what your experience is in dealing with boards? Or do you think it's better than that?
Yeah, I would definitely not paint everybody with the same brush. I think there are fantastic boards who have understood and saw some of these issues coming down the pipe or their radar screen and have, over time, really build the board capability, skill set, and experience in a way that they can truly not just challenge management, but really be supportive and provide support to management in moving forward. I do recognize that companies share with us their concerns and maybe challenges that they are facing in building boards that need to be diverse, that need to include different skill set. Cybersecurity is another one that I hear a lot about. So how do you put all this together? Well, actually, fundamentally, the company has a mandate or purpose is to or basically perform. So how do you build all these additional skill sets within that broader performance and ability to understand and oversee strategy and execution? So some definitely challenges out there, but I wouldn't paint everyone with the same brush in terms of that there is a real problem there.
Question in the front, Iain.
Yeah, hi. Sorry, similar question, but really important. Do you believe investors should actually assist with building the boards? So capital, obviously, even debt or equity, comes with different constraints. I love the idea of it being aligned. I haven't experienced that yet, but I love the idea of it. But building a board, even for the sustainability of a business strategy, is one thing. A changing world and ESG with different facets, that is, it's not just a blank question of are they capable? How are investors, if you're creating those KPIs behind the capital, how are you helping chief execs, lonely chief execs maybe, build those boards? That can be to anyone, actually. Iain, I'll let you choose.
Eoin, do you want to go?
Yeah, I'll happily take that one. So I'm not sure that it is as straightforward for an investor to proactively help build a board. That seems to me incredibly complicated. I think to Amra's point, there's an element of trust that actually a company knows its strategy 10 times better than us as investors and engagers. And that's right. So they have the experience, they have the knowledge of the industry that they are in, and there's a sense in which we can help guide, offer encouragement in certain areas, but going much beyond that is actually pretty challenging. And whether there's a reward to that level of interference, I'm not entirely convinced.
One point maybe I would add is what investors can do, and investors like BlackRock are doing that. We really do look at the board as a whole, and we look at whether the board as a whole, because their team have a required expertise and knowledge for the sector in which they operate in. for the geographical footprint in which they operate in, rather than actually dissecting individual CVs. We absolutely believe that the nomination committees are the right way to nominate directors, and for us to determine whether we believe as a whole that the board can do a good job on behalf of investors.
Just on a side note, Edelman are proud sponsors of the Non-Exec Director Awards, which you should all support and nominate people for. And it's been interesting over the lifetime of those awards. I think it's now in their 16th year, because I was involved previously at the Sunday Times, and so I've been involved for a long time. And just the nature of the way that we assess the candidates has changed radically as all these different factors have come into it. I can see out the corner of my eye, Ben Martin from the Times has a question.
It was just a quick one, because I always get excited about AGM seasons, and I just wondered in Britain, like you used to, a couple of years ago, for example, there was a lot of focus on executive pension arrangements. I just wondered whether there are any issues that are sort of bubbling away on the surface in Britain that you expect to see rise up the agenda in the forthcoming AGM season.
I guess that's for you, Amra.
For my sins. Look, I think some of the trends that we've seen over the last 18 months, I think, are going to continue to influence what happens at the next AGM season. Unfortunately, and I think all of us would agree in this room, we all thought we are past lockdowns and working from home. We are not. And I think that kind of focus in terms of how companies are now hopefully coming out, that recovery period, and how they're coming out of COVID is going to be very much focus of our attention when it comes to AGMs.
Yeah, I could maybe just briefly add to that. So I think, yeah, human capital, the S, has definitely come to the fore with the pandemic. Obviously, climate change remains absolutely front and centre in everybody's minds, but as Johan Rockström said, actually climate change is the easiest of the planetary boundaries to solve for. So actually maybe the more challenging ones will be the conversations around biodiversity. What is that, an ecosystem loss? What does that mean for a corporate?
Yeah, well, we touched on this previously, didn't we? It does seem, I thought hearing that discussion on the panel, the ESG panel, about just the complexity of natural capital, biodiversity, these are difficult things for boards to get their heads around, aren't they? Yeah. That's going to be an interesting one. Now, we are nearing time. Are there any questions coming in on the online chat? Nothing of note. So I think the one last thing, just to round off, just, obviously, you're all governance experts here. In your view, just quick answer, what's the most common blind spot that companies tend to slip up on? When you've kind of given yours already, I think, in terms of biodiversity. Adrian, most common blind spot?
This is where I have a pre-prepared soundbite, isn't it, which I haven't pre-prepared. It's not a blind spot, but I think that the challenge is pace of regulation and change, and how on earth you keep up with it.
And Amra, most common blind spot?
Broader context, being really acutely aware of what's happening around all of us.
And just learning how to adapt to this complexity.
Absolutely.
Yeah. Well, on that note, I'd like to thank you all. It's been, this wraps up the morning session, and there's now lunch. There's a lot of lunch, so feel free to indulge. Obviously, we're planning for a fuller house, but it is great to see so many people that have battled through here. I think Paul Drexler, in his capacity as chairman of London First, has probably left a large stack of membership forms for somewhere for people to sign up to battle through and attend in person. But thank you for a fascinating discussion. Thank you to all the panels this morning, and thank you very much.